Did you know that the top 1% of earners in the US pay almost 40% of all federal income taxes? What does this say about how tax rates really work? In today's video, we'll unravel the complexities of income tax rates, focusing on the difference between effective and overall federal tax rates. Let's get started. Understanding tax rates. A tax rate is the percentage of your income or property value that is paid in taxes. In the US, we use a progressive tax rate system for income taxes. This means that the rate increases as the amount of your taxable income increases. There are different tax brackets, and each bracket has its own rate. The more you earn, the higher the percentage of your income you'll pay in taxes. However, it's important to note that not all of your income is taxed at the same rate due to this bracket system. This setup aims to make taxation fairer, ensuring that those with higher incomes contribute a larger share. Current tax rates. In the US, tax rates for income are structured in what's called marginal tax brackets. These brackets vary depending on your filing status, whether you're single, married filing jointly, married filing separately, or a head of household. In 2023 and 2024, these brackets are set at different percentages and income ranges. The tax brackets for 2023 and 2024 are as follows. 2023 tax brackets: 10% for single individuals earning $11,000 or less, married individuals filing jointly, earning $22,000 or less, married individuals filing separately, earning $11,000 or less, and head of household earning $15,700 or less, 12% to 37% for higher income ranges across different categories, with the top bracket being over $578,125 for single individuals and varying similarly for other categories, and so on. 2024 tax brackets: 10% for single individuals earning $11,600 or less, married individuals filing jointly, earning $23,200 or less, married individuals filing separately, earning $11,600 or less, and head of household earning $16,550 or less, 12% to 37% for higher income ranges, with the top bracket being over $609,350 for single individuals and varying accordingly for other categories, and so on. Let's consider an example. If you're a single filer earning $50,000 in 2023, your income would be divided across the first 2 or 3 tax brackets. You wouldn't pay the rate for the highest bracket on all your income, just the portion that falls within that bracket's range. Similarly, for those filing jointly, the income brackets are wider, acknowledging the combined income of a married couple. So the same income would be taxed differently for a single filer versus a couple filing jointly. These brackets are designed to ensure that those with higher incomes pay a higher rate on their income, but only on the portion of income that falls within each higher bracket. It's a progressive system intended to distribute the tax burden more fairly. Understanding these tax brackets is important, as it affects how much tax you'll pay based on your income level and filing status. Remember, as your income increases, only the additional income is taxed at the higher rate, not your entire income. Marginal tax rate versus effective tax rate. The marginal tax rate is the rate you pay on the last dollar you earn. In the progressive tax system, this means it's the rate for your highest tax bracket. For example, if you're in a 22% tax bracket, your marginal tax rate is 22%. This doesn't mean all your income is taxed at 22%, just the income in that bracket. The effective tax rate is different. It's the average rate you pay on your total income. To calculate it, divide the total tax you pay by your total income. So if you pay $3,000 in taxes on a $30,000 income, your effective tax rate is 10%. This rate is usually lower than your marginal tax rate because it averages out the different rates you pay on different portions of your income. Understanding these two rates helps in financial planning and tax strategies, as they provide a clearer picture of your tax burden and potential savings. Other types of tax rates. Sales tax and capital gains tax are two other types of taxes, distinct from income tax. Sales tax is applied to the sale of goods and services. This tax is a percentage of the price of the item or service and is paid at the time of purchase. Sales tax rates vary by state and sometimes by city or county in the U.S. capital. Gains tax applies to the profit made from selling an asset, like stocks, bonds, or real estate. The rate for capital gains tax can be different from your income tax rate and depends on how long you've held the asset before selling it. Short-term capital gains, for assets held for less than a year, are typically taxed at the same rate as your income tax, while long-term capital gains, for assets held for more than a year, usually have lower tax rates. These taxes differ from income tax in their application and rates. Sales tax is a flat rate on purchases, while capital gains tax rates depend on the duration of asset ownership and are separate from the rates applied to regular income. That wraps up our discussion on tax rates, including the differences between marginal and effective tax rates and how sales and capital gains taxes fit into the bigger picture. If you found this information helpful, please hit the like button and subscribe to our channel for more insights. Your thoughts and questions are important to us, so don't hesitate to share them in the comments section below. And remember, sharing is caring. So if you know someone who could benefit from this video, please share it with them. Thanks for watching.